Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. And after a week of exasperated waiting for some kind of macro event risk on this calendar, we have arrived. We are looking at the first piece of meaningful data to come across the wires this week. We talked a little bit about Eurozone CPI in the week, and that was a little bit of data. But here we get into the meatier things. We get into the Fed. We get into the banking crisis. We get into what is the big story around markets. And that, of course, leads us into U.S. inflation data. The PCE index is what we're after this time around. This is the Fed's favored inflation gauge. It's got a little bit of a different methodology behind it than does CPI. The Fed likes it more. And so this should be a really interesting indicator, especially after markets have been waiting for a read on the Fed all week and kind of stuck in limbo in the absence of that lead. Let's take a look at what we are looking to see as far as expectations, how it might shape what the markets will do across a variety of asset classes, currencies, commodities, stocks, bonds, and get a sense for a tradable approach to how to move forward. So, first, a chart you will have been familiar with if you follow Macro Money. This is a chart of U.S. CPI and PCE, both headline measures of U.S. inflation, graphed over the 2-year U.S. Treasury's break-even rate. The break-even rate is the difference between nominal and real bond yields. So when you want to go from nominal yields, which is what you typically think of as yields, to real yields, which are adjusted for inflation, there is that inflation discount. If you want to get what that discount is, and therefore what is the implied inflation rate in markets, you can just take the difference between nominal yields and real or TIPS yields, and you get that inflation adjustment value. And so that's what we're looking at here in the yellow bars. Basically, the bond market's expectation for where inflation is in 2 years' time. These are monthly bars. So the very last 2 bars here, February is 3.2, and March, as much of it as we've seen so far, so March to date, is 2.7. The main thing that this is telling us is the Fed is off target. If the Fed wants to get to a 2% inflation rate within a 2 to 3 year window, well, here we can clearly see that over a 2-year window, it's closer to 3 than it is to 2. So ostensibly, what this is telling us is not that the Fed has over-tightened, or that even financial conditions in the wake of this SVB crisis and its many outgrowths have over-tightened on the Fed's behalf. We've under-tightened from the looks of it. So the expectation on the PCE number, which of course will inform this narrative, is that we are going to get a decline mirroring the one that we got on CPI. You can see CPI at the last increment ticked lower. The PCE expected to come down as well and hit 5.1% year on year. The 2-month lag here is, of course, because on the one hand, expectations are necessarily forward-looking. Markets anticipate where things are going to go, so there's inherently a lead there. Also, of course, because of data collection on monthly CPI data as relative to real-time break-even rates, which are a function of real-time bond market action, you get some built-in lag as well. So that's why these break-even rates give you an early view of what's coming. And from the looks of it, it appears as though we are near the end of that dip in the break-even rate structure before the February-March pop. Now, there's been a lot of argument in the wake of the SVB collapse and everything that's happened in its wake that we've already seen a tightening of financial conditions because spooked lenders have pulled back on cash, and that's in effect a form of rate hike that does not require the Fed to keep going as hard. And you can see that here. That same break-even rate here expressed as the red line. You see there that's the same as those yellow bars we just saw. And the dark line there, the OFR, Financial Stress Index. That's from the Office of Financial Research, which is a group within the U.S. Treasury Department. So you can see there, as the risk builds with the SVB situation and its various outgrowths in the beginning of this month, break-even rates come in. So inflation expectations come in because that's a form of tightening credit that you see there. And since that issue has, for the moment, stalled, you can see that inflation expectations have paused declining as well and are still worryingly elevated. You can see that as risk has eased, the S&P 500 has come up. So as that OFR stress index has slumped back a bit off the highs, stocks have managed to pull higher. Not surprising there. But what you don't see is a meaningful rebuild in Fed rate hike expectations. So though you've had a stall in the crisis, clearly the market is not convinced that all is well, because inflation expectations, as you can see here, are creeping back to justify, seemingly, the Fed doing more, but Fed rate hike odds have actually not increased. How does one square that? Well, ostensibly then, the moderation, or at least the pausing in these risk readings, is not something the market is taking at face value. They don't think that the worst is over. And that's why these rate hike expectations haven't rebuilt. You can see the 12-month Fed funds future implied rate, which essentially just tells you where the market thinks, based on futures rates, interest rate futures used to hedge the Fed and Fed risk, where rates are going to be a year from any given day. You can see it was supposed to be close to 5.5 just at the beginning of this month. It has now crashed to give or take 4 and has not moved off that square. In fact, you can see in the shape of the yield curve, there's been a significant flattening of the curve now versus before the SVB collapse. The curve there, you can see much more humped and much steeper, especially in the front 6 months, giving us that peak of 5.5. What you're looking at now is, at this point, the end of rate hikes. So you can see that we are not actually expecting to go any higher from the current curve. That's the solid line there. We're at about 4.9, 4.8%. So right in the middle of that 4.75 to 5 range. And you can see that we hold there for the next 3 months or so. So call it end of June. And as we get into July, we're starting to look at cuts. And we look at those cuts out to 2 years, giving us by the end of a 3-year run a Fed funds rate essentially at 3%, which is 50 basis points lower than previously anticipated and along a much shallower path than previously anticipated. Now, this ostensibly is a function of this. The reason we've had this aggressive shift in the curve is because we've had this crisis. You can see that over the past week, that's the big dashed line from a week ago, there has not really been a meaningful change. That would be that quiet in the data. So this is a view that seems to be settling in markets. However, you look at the overall economy, it remains quite strong. So U.S. economic data actually continues to outperform relative to expectations, which is, of course, how you got the build in rate hike odds all the way up to 5.5 in the first place. So looking back at this chart over here, you can see from about October through February, the orange line basically is flat. So the market at that point has concluded that the Fed rate hike cycle conclusion is in sight, that we're not going to get any higher than the terminal rate implied there, which is give or take 5, and basically where we are currently, and that we are going to have that be where the Fed ends. You can see over that period of time a level of calm, and of course that coincided with the recovery in risks sentiment. Stocks did quite well in the fourth quarter of last year and in January of this year. So that was a good 4-month run, a good reprieve for markets worried about the impact of higher rates and the more expensive hurdle rate that they apply to getting capital for any kind of spending, investment or growing a business or buying things, whatever it is, you name it. And you then in February, you can see the orange line starts to go higher. So it starts to climb from about 4.5, which is where it cautiously edged into, back to 5.5. And that was this improvement in economic data from February onward. You'll recall there was that explosive jobs report. There was inflation data that was a bit hotter. And so this is where you get that build in expectations, which gave us much higher rates until the intervening crisis. The crisis having now been seemingly, at least for the moment, contained. By no means do I think that all the shoes have dropped, as it were. I think that that more is probably coming, and we talked about this in detail on Macro Money yesterday, talking about risks in the commercial real estate space. You can check out the recording of that episode for those details, and we'll no doubt keep touching on that subject in the coming days and weeks. But that initial SVB signature Credit Suisse episode having been somewhat ring-fenced, we are left with a U.S. economy that's still doing much better than economist expectations would suggest. That jives well with how U.S. PCE data has performed relative to expectations in recent months. You can see that from basically the tail end of 2020 into 2021, the meat of this Fed story, we have had U.S. inflation outperforming and registering hotter than economists' models have anticipated, specifically on PCE, the index we're looking at for the next 24 hours. Much more so than it's underperformed. In fact, there's only 3 months you can see there where you get basically inline expectations results, just a tiny, tiny sliver of red on the chart there, but the green bars are nice and tall. And in fact, the latest data gives us the biggest outperformance that we've seen since 2013. But what do we know about 2013 and 2014? This is the last start of the previous Fed tightening cycle. This is where the Fed, in the wake of the global financial crisis finally says it's time to unwind QE, it's time to begin raising rates. So we are in a place on the way that the Fed's favored inflation metric is performing, where in past, the Fed has said, you know what, this inflation is looking hotter than anticipated. We need to do something. And if the crisis is then ostensibly contained, at least for now, and the message that the Fed has sent out there is that the way that we're going to deal with banking issues is not the blunt instrument that is economy-wide interest rates, that those are reserved for monetary policy that's seeking to control inflation, seeking to foster maximum employment in the context of on-target inflation. And then what we're going to do is deal with the banks as an independent policy track, a macroprudential policy that isn't getting in the way of the bigger monetary story. Well, then this data may well tell markets that their rate cut expectations are offsides. This is what we're looking at for the current setup, just to give you the full lay of the land here. And we'll look at the implications for overall assets in just a moment. So you can see for May, you are looking at a 55% chance of another hike. So looking at the number of hikes and cuts column, looking at the situation that you see in the percent hike cut column, you're basically getting the same exact story. And what you're seeing there is the expectation that you are going to, or at least the sense that you've baked in about 14 basis points out of a 25 basis point standard hike. So you're looking at about half of a hike that's been baked in, maybe a little bit more. Then you have already by June, the sense that you're holding still. So no rate move implied there, and the inkling of cuts starting to show up. You get the majority of a full hike baked in by September and fully baked in by November, with, at that stage, a 26% chance of a 50 basis point easing cycle. You then get into a place by December where that cut is all the way in, and there's an almost 80% chance of a 50 basis point hike. And by January, those two cuts are both there. So you've reduced rates by 50 basis points as relative to now. And there is a 39% chance of a still further cut, if you look at that number of hikes, cuts column yet again. So you can see that in the implied rate delta column, you are at this point looking at a situation where you have a relative to now net 61 basis points in easing that are baked in by January. So a full 50 basis points in cuts and maybe a little more, which of course is something that gives us a worrying situation if we get hotter inflation data that then argues, well, actually, your break-even rates are at 2.7%, so you've under-tightened. The Fed is saying, we got to keep going. Meanwhile, the markets are expecting the opposite of what both the incoming economic data and Fed rhetoric seem to be implying. And of course, in that kind of a situation, one starts to really wonder how much of an asymmetric repricing risk there is on one side of this issue versus the other. Because, of course, if we get a weak number, well, the markets are already baked in for cuts. There is but so many more cuts that could get priced in, considering the Fed continues to argue there's not going to be any. And the market simply doesn't buy it. The greater volatility risk is that the market finds itself mispriced for what the data and the Fed are saying. And of course, one can take the data with a grain of salt, but taking the sum total of the Fed and the data and what the market is telling us all in one go, and ignoring that becomes very difficult. Now you start to have a compounding of evidence to suggest that the market is not where it needs to be in terms of expectations. And that, of course, becomes a significant volatility risk. So, what does that mean from a practical trading perspective? So here we're looking at the S&P 500 as a kind of benchmark for risk on, risk off dynamics. Consider here that May ostensibly is where we have the top in rates now baked in, so we're looking at that. And then we're looking at the end of the year. That's the red line there. That's where rates are going to be, according to Fed Funds Futures, in December. Notice that the S&P 500 begins to recover. That's the yellow bars on the bottom, and the dashed line there is just the 5-day moving average to get the trend a little bit more discernible. Notice that rise in October going into November. That's where the uptrend begins, the most recent one for the S&P 500. Notice that's also the place where rate hike expectations peak and get stuck into a long-term range until you get to the beginning of February, where they start to rebuild around that better economic data, and also where the S&P 500 starts going down. Then come the beginning of March, you get the really exuberant decline in rate hike expectations, and of course the S&P takes a dip, but as the risk eases, stocks recover a bit. And that's the risk easing off. But if the conversation gets back to rate hikes, because the risk of this outside factor has been contained, and we're back to what's inflation telling us, what growth conditions are telling us, well, then ostensibly we're back to what February was showing us. And that becomes a similar kind of dynamic, where the recovery in rate hike odds is risk negative, and so S&P comes off. By the same token, that would be likely a stronger U.S. dollar, both on haven grounds and on higher yield grounds. Perhaps then also weakness in the range of cyclical and sentiment-sensitive assets. Crude oil has had a nice recovery there, which looks vulnerable. Gold has a nice recovery thanks to the collapse in rates that now looks vulnerable. The yen, which has had a nice recovery thanks to the collapse in rates, may be a bit vulnerable near term. All of these things start to come together to paint, once again, this Fed on, Fed off picture, where assets essentially split into which ones do well in a Fed on versus Fed off environment and which don't. And get back to this kind of simplified dynamic that we saw before the SVB collapse. And as long as the banking situation remains contained, and we get this inflation number to really underscore what the Fed is telling us, that's a move that can catch markets wrong-footed, given where expectations are looking here. And so there could be quite a bit of a readjustment, quite a bit of a reaction that is implied here. That is macro money for today. Thank you very much for joining me. This is our last show for the week. We're here Monday through Thursday, just after overtime, a show I do with Chris Vecchio, head of Futures and Forex here at Tasty Live. That's also Monday through Thursday. I'll be on Fridays for Futures Power Hour with Chris as well. All but for this Friday, actually. I'm out this Friday, but normally I am there for that. And then on Sunday for First Call with Tom and Tony. Outside of the shows, you can catch me opining on Twitter at Ilya Spivak. Thanks very much once again, everybody. Happy trading out there. Godspeed.